Hello, friends. Are you trying to find a job in the Canadian banking sector? Don't you think it'll be really helpful if you have the basic knowledge of the bank financials? I can help you learn that in the most layman terms. A Canadian bank operates in four major sectors: capital markets, retail banking, wealth management, and commercial banking. In this first series of videos, I want to talk about how the capital market division operates and makes money. To understand a bank, we need to understand a bank's balance sheet. Let's start by looking at what a capital market balance sheet looks like, and then in the later videos, we can go into the details of how the balance sheet translates to revenue. As you can see in this capital market balance sheet, we have assets on the left and liabilities and shareholders' equity on the right. We have 10 major items on this balance sheet. I would like to start with number 9, which is kind of self-explanatory. Shareholders buy the shares of the bank. That is how the bank gets its initial capital. It shows up as shareholders' equity on the right side of the balance sheet. Cash received in this process shows up as an asset. Let's now talk about rows 1, 2, and 3 of the balance sheet. If the bank buy equity securities or debt securities or precious metals with the cash it has, those securities or precious metals will show up as asset on the balance sheet, and the cash will go down against these securities or precious metals. On the other hand, if the bank sells short securities, that is, bank sells the securities it does not own by borrowing it from another party or broker, the cash proceeds received from selling this security show up as a liability. This is because the bank does not own this money and will need to return this money sooner or later whenever it decides to buy back the security it sold short. Let's now talk about row 4, cash collateral given against securities borrowed. If the bank borrows a security because it needs it for one of its clients, it will have to post a cash collateral against this security. That cash posted is expected to be received back at a later date when the bank will return the security. Hence, the cash posted shows up as an asset on the bank's balance sheet. The security borrowed will be an off-balance sheet item and not show up on the balance sheet. This is because only those securities show up on a bank's balance sheet where the market risk of change in securities price is borne by the bank. In this case, the bank is expected to give back the securities to the lender at a later date and does not bear the risk of a change in market price of the securities. I will not talk about the liabilities for row 4 because if you understood the concept of assets for this line, liability has the exact same logic, just that the bank is on the opposite side of the trade in that case. Coming to row 5, cash posted against reverse repos. The concept here is very similar to the securities borrowed concept in row 4. In case of reverse repos, bank buys a security from a client by posting cash collateral with a promise to sell it back at a lower price at a later date. That cash collateral posted shows up as an asset. Now you'll ask, why will bank sell it back at a lower price? You can think of it as a fees paid to the client for getting the security when the bank needed it. We'll go into more details when I walk you through specific trade examples in later videos. And similar to row 4, I will skip the explanation for liabilities for row 5 as well. Let's move to now row 6 and 7. I want to talk about these two together as the flow of these two lines goes hand in hand. Whenever a bank has a derivative mark-to-market profit, it will also see cash collateral received against derivatives and vice versa. So usually whenever the bank enters in a derivative agreement with a counterparty, there's a clause around daily posting of margin or cash collateral by the losing party to the extent of the loss on that day. I'm sure it's a lot to digest. Let me try to explain this with the help of an example. Let's say bank has bought an OTC forward with Apple as the underlying security. Let's assume that the price of Apple has gone up by $5 at the end of the day. So bank is making a profit, and that $5 will show up in row 6, asset side, derivatives mark to market profit. The client will be expected to post a variation margin or cash collateral to the extent of that $5 loss, and that will show up as a cash collateral received against derivatives. So asset side in row 6 goes up by $5, and the liability side in row 7 goes up by $5. And similar would be the case when the Apple security has gone down by $5. In that case, the bank will be expected to post a collateral of $5. It will show up as an asset on the bank's balance sheet, cash collateral given to the client against derivatives of $5, and there'll be a mark to market loss, and that loss will show up as derivative mark to market loss of $5. Row 8, loans and deposits. I think these are self-explanatory. Loans given to the client are an asset. Banks expects to receive them back in the future. Deposits are a liability. With that, I would like to conclude this session. I hope this helped you get some understanding of the capital market financials. We'll go into specific examples of trades in the next few sessions, which will help you understand the balance sheet even better and also help you see how the capital market division actually makes money. Thank you.
I hope you enjoyed the video. Please do like, share and subscribe.